All right. Okay, so we'll get started. Good morning, everyone. Welcome to our webinar today on Africa Founders Playbook, Getting Investor Ready. Kayode, are you also able to come on video so we're able to see? Excellent. Okay, yeah, I see you now. Okay. My name is Yinka Ojikutu. I'll be the moderator for today's webinar. I'm a second-year student at Columbia Business School. I'm currently completing my summer internship at the AFC. Prior to business school, I was and I still am a VP at Leonine. And prior to Leonine, I worked within PwC's deal advisory team for a few years. So essentially, I worked alongside Haneef at PwC. By way of introduction and sort of setting the rules for today, we're going to start off with an introduction of the four wonderful panelists that we have online. And then we'll move on to a chat for about 50 minutes with the panelists where we'll pose different questions that are top of mind for our attendees today. And then we'll go into about 10 minutes of Q&A and then call it a wrap sometime close to 1 p.m. I hope that works for all our panelists.
Works.
Fantastic. So first thing on my list is to introduce our wonderful panelists, and I'll start with Beverley. Beverley Agbakoba-Onyejianya is an associate partner, head of sports, entertainment, and tech, and Olisa Agbakoba. She has 14 years experience in banking and capital markets across the UK and Nigeria, and she's currently a member of the Nigerian Economic Summit Group and the Lagos Divisional Football Association. Beverley, thank you for joining us today.
Thank you for having me.
Thank you, Beverley. Next, we have Kayode Oyewole. Kayode Oyewole is a partner at Ventures Platform, where he helps companies find product market fit and scale. To date, Kayode has led 30+ investments in the past few years, and he was an early employee at Max NG, the popular motorcycle ride-hailing startup. And Kayode currently leads Labs by ARM, a fintech accelerator. Thank you for joining us, Kayode.
Great to be here.
Next, we have Adedayo Amzat. Adedayo Amzat is founder of Zedcrest, also the founder of Zedvance, the popular consumer lending platform. Prior to founding Zedcrest, Adedayo Amzat used to work within the treasury team at Access Bank and is also a CFA charter holder. Welcome, Dayo. Thank you for joining us today.
Thanks for having me.
And last, but definitely not least, we have Haneef Abbas. Haneef Abbas is the co-founder and CEO of Leonine. Prior to Leonine, he was head of corporate finance at ARM. And prior to that, he worked in Access Bank's investment banking division and PwC's deal advisory team. Haneef Abbas is also a CFA charter holder. Haneef, thanks for joining us today.
Thanks, Yinka.
All right. So this conversation is an important sequel to an ebook that we dropped last year. Essentially, we call the ebook A Founder's Guide to Capital Raising. We've had several interesting conversations following the launch of that ebook. Several people have given us comments and inputs, and we thought it was important to bring experts into the room to sort of discuss some of the nuances of raising money, depending on like what stage of the early stage cycle of a company that you're in right now. So in-house, we have an investor, we have finance professional, we have two investors actually, we have finance professionals. Even though at some level, everyone is an investor in their personal capacity, we also have a legal expert that can give us color in that regard, right? So please, if you have questions, put them in the chat, and given the time we have at the end of the session, we'll take as many questions as we possibly can. So I'll start with Kayode. So Kayode, tell us, from a VC perspective, what does it mean when you say a startup, or when you say startup is investor ready? What does this mean to you?
I mean, there are a bunch of ways to look at that. I mean, sort of like the way we invest is we sort of like invest across multiple stages, right? So we invest across pre-seed and seed, and obviously post-seed. So sort of like we wouldn't really think so much about investment readiness at the pre-seed stage, because some of the parameters by which you would use to judge if a company was investor ready might not necessarily apply at the pre-seed stage, right? So at the pre-seed stage, I'm talking about companies probably very early. They just have a minimum viable product. They probably have just a couple users, right? at that stage, it's hard to say if they're investor ready or not. However, the framework which we sort of like evaluate companies like that is we sort of look at the quality of the team. In most cases, everything the company tells us will be wrong. So all their projections, their business model, almost everything, all their core hypotheses will be wrong. So we don't spend, and I see founders put a lot of time to say this. It's good to think through that, but in most cases, when you get to the market, everything you talk about will be wrong. So what we sort of like tend to focus on at that stage is sort of like look at the quality of the team, right? And in terms of quality of the team, what we're really looking at is first and foremost, at the core of every company, a company is trying to build a great product and trying to acquire customers. Every other thing is just added, layered on top of that, right? So we look for, does the team have a balance of people that can build the product, right, and sell the product, right? So again, because we're sort of like biased towards technology, so essentially we look for teams that have either the core software engineer and then somebody that understands distribution. That's the first thing. Second thing is, does the team have unique insight into the problems they're trying to solve, right? So especially if you're going after really, really technical spaces, you're trying to build something in healthcare, right? How embedded are you within the problem? How much insight do you have? What do you know that's hard for other people to know? What insight do you have that other people really do not have, or it will take them a lot of time to figure out? So we sort of like look at the team. And the next thing we look at is the market opportunity to say, is there a big market? Or more importantly, will this market grow over time, or will it decline over time, right? So we sort of like spend a lot of time looking at that. And then the third thing we just think through is the product. How has the team thinking about the product? At the first version they've built, does it solve any problem for anybody, right? It might not be perfect, but sort of like, are there 1, 2, or 3 people that use the product and love it, right? So at that stage, those are sort of like the things we're evaluating. We sort of like feel like you'll figure out your business model, you'll figure out a bunch of things as you move along. At the seed stage and post-seed stage, we then look for more things, right? So we then look for some sort of like market validation, right? So how much traction do you have? Sort of like, how sticky is your product? Are users coming back? But I guess at the core of everything, in terms of just evaluating companies, at the core first is the quality of the team, either at the pre-seed or seed stage, right? So solid founders have a deep understanding of the market, have shown personal skin in the game. So they have either built a minimum viable product, acquired users. They have done a few things before coming to look for financing. And more importantly, sort of like a balanced team, people that can build and people that can sell the product.
Yeah, thank you very much for the color, Kayode. In fact, I've once had an investor like yourself say to me that they get very wary when startups come with documents that are too clean, because essentially it means they're burying bodies and they're focusing on the wrong things at that stage. But I'll dare to say that irrespective, so the team, the market, understanding of the market, being able to achieve product market fit are all important things, right? But there still needs to be a medium where startups are able to communicate this to their would-be founders, right? So I would like to sort of move to Haneef on this point. Haneef, can you tell us some of these documents that Kayode has told us today are most likely wrong, right? Can you tell us what some of these documents are and some of the things that founders can do to better meet the needs of people like Kayode and to better demonstrate their understanding of the market and their understanding or better demonstrate product market fit in these documents?
All right, thanks a lot, Yinka. So, I think one of the main documents that founders usually, come up with and, share with investors is the pitch deck, right? And in the pitch deck, one of the first things you're trying to address is the problem, right? And from what Kayode has also mentioned, that's one of the very first things that, sort of gives a sense, what problem are you trying to solve? How big is the opportunity or the potential opportunity? Because for some of these solutions or some of these problems, it's still a niche market, but what's the outlook? What does it look like? What's the potential size? How big is the problem? And then, in terms of impact as well, what sort of impact is it likely to have? And how can it grow in terms of market size? So that problem is something that you find in the pitch deck and then you try to address. One other important thing is how then do you solve it, right? And again, Kayode alluded to having unique insights about the domain area or the market space you're trying to do. So what exactly is your approach? And if you've built a minimum viable product, how does it work and how does it solve the problem? What are the customers saying? The people that are using it, traction is very important when you speak to investors. So you've built up, or you've identified a problem, you've built something that addresses it. And then, in terms of feedback, are they coming back? Are they using it? What are they saying? And does it satisfy that problem? So that's also important, right? And then the business model itself is something that I think more founders should pay a lot more attention to, in terms of how does everything fit in. And like Kayode mentioned, it's going to evolve. And usually when we work with founders and businesses, we tell them that your business model is not something you just do at the beginning of the process and you dump. It's something that is a living document. You go back to it frequently, discuss with your teams, with other stakeholders, and you update it, you iterate it. So yes, at the initial stage, something like that might be wrong to a large extent, or it might change. And then maybe you pivot at some stage after you find out if something doesn't work quite well, or based on feedback from your customers. Because again, two important things in the startup space is building your product and talking to customers. So during those two processes, there will be different feedbacks and iterations that come in, and then you need to adjust. And then at that stage, some founders might have also come up with a financial forecast, which is one of the other documents that you might need to prepare, the financial forecast. And at pre-seed stage, you don't find a lot of founders with that, but at the seed stage, you should start having things around that. And again, the more often than not, the projections are always wrong. But what it does for founders is it gets them thinking about the important things that they need to be top of mind. A lot of times you speak to a founder, I'll tell you I need 100K for something. And then, if you had run the numbers, you don't need 100K, you need more than that, right? But that's what part of what the financial model does for you. It helps you, visualize some of the key drivers and elements that are required to get your product to the market and to get you scaling and growing. So I think those two are very important. Then at later stages, you then start to have other documents like, information memorandum, business plan, and whatnot. But I think having those processes done early is very useful, even though it's going to change. Everybody knows that, but it shows that you're thinking about the opportunity the right way, and then you're able to also articulate that clearly to your investors and other stakeholders that you engage with.
Thank you very much, Haneef. So in addition to having an awesome team, like Kayode said, having a strong understanding of your market, the founders on this call should please, even if it's a back of envelope calculation, have a sense of what the market for your business is and the value you hope to capture along that value chain, such that when you're speaking to investors like Dayo or Kayode, you won't go there with only a plan. You have a clear plan, and they can also assess how they're able to benefit from this plan. But I'm moving on the discussion now to Beverley, right? So in our different experiences, we've met a lot of trigger-happy founders that are happy to execute whatever it is, right? Because they assume that at the initial stages, things are low stakes. I haven't even built anything. So if someone wants to take 50% of my business, it's fine. Can you share from your experiences? Why is it important to get a lawyer in the room very early on? And what are some of the benefits that startup founders can get from doing that? You're muted, Beverley.
Thank you so much. So, we've talked so far, my fellow panelists have talked about, I would say, the more exciting sides of, the startup ecosystem, talking about, fundraising, we're talking about building teams, building products, services. And it's interesting because every time I speak with founders at whichever stage, it always feels as if legal is almost like, it's something that we need to have, as opposed to something that we really appreciate or understand. So I think one of the things I really like to stress when I get such awesome opportunities like this is, I'll take it back to front. Why do we need lawyers in the room? We need lawyers in the room because when the founders are all passionate, going hard, building and, generally getting very excited and caught up in what they're doing, it's very, very easy to miss the pitfalls. We've talked about, Kayode has talked about building teams. You really need a fantastic team in order to build something great. That's just the truth. And one thing I've noticed with founders, like I found in certain instances, a team of 6 will come and say, oh, we've got something we want to build. We're super excited. And I always feel like I'm the stick in the mud because I'm saying to myself, wow, these are 6 people. What are the odds that at the end of even 6 months, there'll still be 4 people left? And I try to explain these things that, it's really important to establish the roles and responsibilities amongst themselves. I mean, some people may feel uncomfortable about rushing into, say, a founders agreement, but it's really important that every single aspect of what it is you're building, whether it's the people side, the product side, you need a lawyer in the room or on your side to tell you what the pros and cons are, to tell you what your potential liabilities are. So, and that may not be readily apparent, especially when, passion gets involved. You get founders who are, say, best friends from university. And yeah, that happens. We've seen some amazing turn giants that started off from university. But the truth of the matter is, as we all know, 80% of businesses die within 3 years. So the likelihood, the odds are actually less in your favor. So it's really important, as uncomfortable as that discussion can be, to really get the fundamentals right in the beginning. So who is everyone to each other? What are the various roles? Are we drawing up the relevant agreements that define our roles? Again, I think somebody also talked about giving away too much equity. One thing I'm beginning to notice is people can't actually afford to pay for certain services. So they say, okay, you know what? Just give me equity and I'll be your coder, I'll be your developer. And you find people giving away large chunks of their business, not realizing that 5% that you think is nothing, it could be quite huge. So I think it's really important that people begin to see lawyers, legal counsel as enablers. We are there to help things work out. We're helped to make things be more seamless. We're there to spot the booby traps and all the things that you may not necessarily see, because these things are real. We're there to also highlight, look, this term sheet may not be binding, but do you really want to give out that much equity? So lawyers are really essential, basically, at any stage, at the divesting stage, fundraising stage, and especially when things are going really well. Lawyers are essential no matter what the stage is. I think really the PR that lawyers need is, demonstrating competence. No, it's true, because, I have to say it as it is. The hard conversation there with lawyers, it's almost like they always have to prove that they are not going to be the sticks in the mud, and that they are going to bring value, because most people don't feel that lawyers bring value, because we aren't the ones doing the grunt work, so to speak. But there is a lot of value to be said in process, in structure. The legal team, depending on their competence, because as we all know, lawyer is a generic term, right? There's so many types of lawyers, so it's so important that you engage a counsel that has that specialist expertise that you need. So whether it's IP, I mean, it tends to get quite expensive. I mean, in this part of the world, here in Africa and Nigeria, you could almost say that vis-a-vis the West, the US, legal fees are not bad, over here. It's true, Yinka, it's true. But, there's still that, you have to almost justify and explain why you need to have your legal team on board. And obviously you have to have the right expertise. So look out for a legal team that can provide intellectual property expertise. This is important. Why? Because whatever you're building, whether it's a product, whether it's a service, it will have a brand. And we all know the power of branding, okay? So that brand, obviously, you don't want that brand to be vested in one person. That would be deadly, because if that person leaves, they're with the intellectual property. So it's very important to make sure you engage legal teams or a lawyer that has the right skill set, because you're not going to go get a family lawyer to do banking and financial services work, obviously. So yeah, I could go on. There's just so many reasons why you need good legal. But for me, it's definitely about, the contracts. And one thing I must say, I saw something the other day on social media and it made me chuckle. And it basically said, please, founders, don't forget, your investor's lawyer is not your lawyer. It's the investor's lawyer. So always make sure you lawyer up. Ideally, both sides should have their counsel. So the investors will have theirs, looking out for their interests, and obviously the founders will have theirs, looking out for their interests. So it's a matter of both legal teams coming together, meeting in the middle. So there's so many, but that's kind of like the preliminary off the top of head I can give you.
Thank you so much, Beverley. I think what stood out the most for me is this understanding or this belief that a lot of founders have that lawyers are for the big boys. Lawyers are not for the big boys. Lawyers are for everyone, right? So I guess when the takeaway for founders is when you're thinking about your runway or thinking about how much cash you need to sustain your operations until the next raise, definitely think about plugging in an amount for legal services, and you'll be thankful that you did so. Thank you, Beverley.
Awesome.
So moving on now to Dayo. Given all the things that Haneef, Kayode, and Beverley have just said, right, on your journey as a founder and more recently as an investor, what are some of the things you wish you knew when you were starting out? And please be candid with us. If you made some of those mistakes that are thinking now in hindsight in which, oh, I shouldn't have done that. Oh, I'm thankful I did that. It really helped propel my business to where it is today. What are some of those things that you wish you knew back when you started out, Zedcrest and Zedvance?
Okay, thank you. Now with a business that employs 500 people plus in Nigeria, and in the next coming months across Africa, what I think is critical is from day one being very deliberate about your mission and understanding what your entire mission is about. So personally, what I could have done better, if I remember well, it's been a long time. This is since 2012. So I could have been a lot more involved in designing what the journey would be. And hear me well, right? At the time, this is not, there was not the age of fundraising, wasn't the age of pre-seed, seed, none of that. I had to essentially bootstrap my own journey, And if you're bootstrapping your journey, right, you are very mindful of your costs. And so therefore you make the mistake of building from the ground up. Hear me again. When you build from the ground up, what do? You say you build according to the current size of your business or your opportunity. And you say, okay, I'm servicing 10 customers. So therefore, for my head of finance, maybe all I need is someone that is just a graduate of finance. For my salesperson, a fresh graduate will do. So you essentially just build a team around what you currently have, right? Which is very young, smart people, but essentially you just focus on the size of your business. Okay, your payroll should not be more than 500,000 naira per month or 1 million naira per month, and then you constrain yourself to that point. What happens is everyone is driven. You're driven, your people are driven, but that awesome, thorough experience is not there. So as you start to scale, sometimes the opportunity scales faster than the team you've built. And then you now have a problem where you're not coming to that same game with the same firepower as someone who's coming a lot more intentional, who is comfortable with having a steep J-curve in the early days, doesn't care about losses in the early days. And then he knows that the moment he gets more market share, it's going to become heavily profitable. And then as you grow bigger, it becomes a growing pain. You've sort of built a culture where you are not, the DNA is not super experienced if you're not careful. You essentially just have driven people, but you've not been able to attract people at the top of their game, people who have 10, 15 years experience, who are ex-VPs in this, ex-VPs in that, who can help you chart like a thoroughly ambitious journey. And you can struggle with that growth, especially if the market opportunity is large. And then you sort of just keep on struggling to essentially we cracked it, but that was our own story in the very early days. We struggled to catch up with the growth opportunities that we have because we did not sufficiently pay attention to building the management structure and the management strengths required to take your company from point one, because hey, we'll go from 0 to 1, but to go from 1 to 10, we had to take a step back and redesign the entire framework to achieve that journey. And for most people, I mean, we're all coming from Africa where, I mean, thankfully now there's some capital, but you need to fine-tune your mind and understand that capital is just one part of the framework. So if you focus exclusively on how much capital do I have access to now, you may end up building something that will be suboptimal, that will not be good enough to scale. And then it becomes challenging to grow because now everybody must build a business with ambition, right? Now, as a founder, right, what I find very interesting, like, I mean, just like what every other person has said, I would just like to add that I always like people with very huge ambitions, right? If you understand the size of the pie you are going after, then it is more likely that you would have done a lot more thorough research. You would be confident enough to go and meet people that would be value adding to your journey. You won't be scared to go solve the hard problems first. And they say it is who solves the hardest problems first that wins. You know, you'll be comfortable enough to do what you have to do to win. If it's about convincing an ex-VP from Microsoft to join you, if that is what it takes, if you're so sure of the kind of journey you're going after, you know, if you Shola of Paystack was in an interview some days ago, and then he said when they started Paystack, they literally had to go beg their former bosses and in the industry to come work with Paystack. It takes a certain level of confidence in the journey that you have. It takes a certain level of ambition where you have some sort of guarantee that this pie is huge. I can't depend on my own firepower, on my own knowledge base, on my own experience to crack it. You know, so therefore I need to go and bring in senior people with a lot more strength, grit, and experience in the space. And then that becomes a self-fulfilling prophecy. It becomes self-fulfilling because we've now brought in stronger people. They're able to help you validate your journey better. They're able to run each vertical of your business stronger. And then in a sense, they essentially create their own success. And then the journey becomes successful. I think we're extremely successful as a business to the point where we are now able to have our own internal venture fund where we backed about 50 companies, spent about $5 million in 24 months. So I think we're successful, but I mean, maybe I would have less of a bald head. So this is what I'm about to pay for it. We're about to knock our wins through all the. If I have a chance to do this again, I'll do it better.
Thank you so much for that. I guess everything comes at a cost. It's fortunate or unfortunate that the cost of this has been your gray hair or your hair, so to speak. But moving on to Kayode, right? So in managing ambition and risk, from an investor's perspective, I mean, we hear so many series in the news that we're also soon enough we're going to run out of letters of the alphabet because we hear Series A, Series B, Series C, Series D. At each of these stages, what level of ambition and risk are you looking for? And more generally, what are the ideal sources of capital? So when should you be speaking to angels? When should you be speaking to family and friends, frankly? When should you be speaking to institutional investors? So what are the appropriate sources of capital at this? What do these different stages mean? What are the appropriate sources of capital for each one? And how much ambition versus risk should founders demonstrate at each of these points from your experience?
So a few things. I mean, I guess the first thing to determine for every founder or entrepreneur is to figure out if you're building a venture backable business. And I think it's very important that you sort of like this distinction early before trying to raise financing. And I know that there's so much debate around SME versus startup. I'm not going to try and add to that debate, but where I fall on the side of the debate is that an SME is not a startup, right? I mean, and again, startup just like the whole definition of startup and just like the whole movement about startup has been equal to growth, right? Essentially, so companies that can scale really fast without necessarily adding on so much physical assets, right? And that's the whole startup movement, right? So I think the first thing before trying to raise capital is to ask yourself is this really a venture backable business, right? Again, the way venture capital works is probably one of the most riskiest asset class, right? We jet industry standard is about 80% of your investment will return 0 returns, right? And I know this is trying to think we're really smart and we can find great companies. I mean, for us as at today, our debt portfolio is now up to 20%, but like we're still anticipating and we're investing in about 60 plus companies. But if it to 80%, we wouldn't be surprised. We hope it doesn't get there. We think we'll find good companies. Like it's possible it gets there. So this is sort of like follows law, right? Where you expect that maybe 5% of your portfolio will sort of like return, the alpha you're looking for in terms of portfolio return, right? 4, 5, 6 times the total value of the portfolio. So essentially, when I'm looking at the company, the first question I'm asking myself is, can this company potentially return the whole of my fund 5 times over, right? So if I have a $10 million fund, essentially I'm saying, can this company give me $50 million? Now, for the company to give me $50 million, simply, let's assume at exit, I own 10% of the company, right? That means the company needs to exit at a value not of $500 million, right? So the question I'm asking myself is, can this company become a $500 million company, right? And to if we're being honest, very few businesses can really get there, right? So if you've decided that what you're building is high growth, high scale type company, and then now you need capital to go build out. I mean, I think in the early stage, I mean, before trying to, if you have, some founders have a decent network. I mean, if somebody like Shola leaves Stripe today and say, I'm invested in Paystack and says, I want to start a food business, I'm sure all the VCs across Africa will be lining up to say, yeah, take our money. We don't care what you're building, right? And I have a few founders like that within our network that, like, if they say they want to start something, we don't want to hear what it is. The first question is, take our money. They tell us the idea after, right? So we believe in them quite a bit. We've seen what they've done with their existing companies, right? But like, if you're not that kind of person, you don't have a network, that people that can fund you, you don't have people on your WhatsApp that you can message and they'll say, take 50, take $20K. I mean, I know you found that I raised about $1 million in about 2 weeks via WhatsApp chat. Like, I'm starting a new company. I like you, like very few people have that kind of network, right? So if you're not that kind of person, I guess the first point of call would be friends and family and maybe fools. They say the triple F, friends, family, and fools. So essentially, you want to look at, and for me, the first company I did, that was essentially how I funded it. I remember my friend at PwC was giving me a portion of the salary every month, right, to essentially fund the company. And that's how we got off the ground. So essentially, you want to look for people that believe in you, right? And they don't necessarily have to be very wealthy, right? I remember 3 of my friends did something similar, essentially gave me a portion of the salary for a few months, right? And that's how we got started, right? So essentially, friends, family are the first point of call for lots of people. Some people will be more lucky than others in that they have friends and family that can give them way more capital. But the point is, you want to get started, right? And after that, when you've demonstrated that there's something here, this works. Now, it doesn't have to be 1 million users. It could be something as simple as 20 users, 10 users, but you can show that people like this, people are willing to pay for this, people find this really valuable. They then approach early stage investors, right? So people like us invest at the early stage. And the interesting thing is, due to the growth in the ecosystem, there are a bunch of new funds almost launching almost every other week, right? So essentially, there are a bunch of people that invest at the early stage. So you want to raise that early stage money, and usually you raise that capital to further build out your product. Most times, your first version is clunky. It works, but it's not great, right? You wouldn't win a lot of market share with that. So you essentially raise the first stage of capital to then fully build out this product, right? And consequently, when you have a product that is going, that you're seeing some traction, you're seeing some stickiness, most of the capital you then begin to raise. So things like seed, Series A, Series B, in most cases are using to fund growth, right? Because again, back to what we said about startups is equal growth, right? You want to be able to grow the company as fast as possible. You want to be able to get into new markets, get into new geographies. And I'm beginning to see an interesting trend where Nigerian companies are going to begin to expand to market outside of Africa. We recently had a portfolio company that expanded to Brazil, so like that's sort of like ambition, because again, the guy sitting in Boston or San Francisco, when he's building a company, he's not thinking about, I'm building a company for San Fran. In his mind, the first thing he's thinking about is, I'm building a company for the world. Like, he doesn't go on the speech deck and say, I'm building a company for the US market. Like, he says that we're building a payment bureau for the world. US is our first market, but very soon we begin to talk about Europe, talk about Asia, talk about Africa. And the question is, if the internet has democratized that sort of like opportunity for the world, why are we as Africans not sort of like leveraging that same opportunity? And I guess that leads me into ambition, right? So at the end of the day, we love ambitious founders, to be honest, right? I mean, again, this is about power law. 2, 5, 10% of your portfolio will return the whole value of the portfolio over and over again, right? So you want to invest in these companies that, the founders are super, super ambitious. Because the thing about ambition is, in most cases, you can't drive ambition into people, right? I mean, people might see the market opportunity and because of that get a little more ambitious. But what we found is, like, if founder is not ambitious, most times when the market is really going fast, he just gets comfortable and is happy to do $500K monthly revenue. To him, that's like super great. He never thought he would get there, and now he's there. He just want to relax and be taken care of, right? So essentially, right, you want to fund companies that are super, super ambitious. I'd rather fund a founder that is willing to, like, go all the way, than somebody that is willing to play it safe, right? Because even if the founder doesn't necessarily, capture, the whole market share, most likely would have made a lot of progress, And in terms of just balancing ambition with risk, I guess that's where sort of like having a quality team comes in. Because again, as you begin to expand and experiment, especially as you begin to go to other markets, you begin to realize that there are different nuances about the market, right? And what made your product work in Nigeria might not necessarily make it work in Ivory Coast, right? Regulations, a bunch of things, processes are different, right? So essentially, founders might be great at that sort of like high level thinking, just, charting the vision, but then you don't need all the systems and structure to be able to balance. And this is where we begin to say, like, new sets of problems arise. We saw early days that it was hard for a lot of founders to make the leap from managing a team of 20 to managing a team of 50 and above, right? Some of the founders that made that leap in the early days of their portfolio, everything started to break, right? Essentially, culture was breaking, support was breaking. So sort of like at that point, you then begin to need the systems and the structure to be able to manage all those things, right? And obviously manage all the risks associated with scaling, right? So I guess the balance is, as you begin to scale, I think similar to what Dario said, you then need this high quality people that scaled similar things in other companies. You then need their expertise to be able to create the right process, right system internally that enables you balance your ambition as you scale, so that things don't break and eventually the company doesn't burn to the ground.
Thank you, Kayode. Just piggybacking off what you said, a lot of people, what you said about repeat founders and certain industries, there's a growing market sentiment that there's like a huge occurrence of overvaluations, right? Essentially, if Shola also texted me that you're starting whatever business, waste management, food, I'll give him my money too. But perceptions like that are likely to create overvaluations in the market. Also, things like recent Paystack, Flutterwave, capital raise, showing how much the early investors have grown in value, right, will create a fear of missing out that can potentially cause an overvaluation in the fintech market, right? But I guess, depending on how much time we have at the end, we'll explore that in more detail. But I wanted us to move to some of the more technical aspects of managing that risk, both from the investor side and from the founder side. And Haneef, I'll come to you for this. So people use several securities or several instruments, so to speak, to invest. So there's straight equity, there's debt, there's quasi-equity, preference shares, convertible debt, all of these things, right? Can you explain to our audience what all these different securities are and how they protect the different parties to a deal?
All right, thanks a lot, Yinka. So I think one of the very basic things in finance and investing is risk and return, right? So like you rightly mentioned, for some of these different securities, they are designed to hedge against certain kinds of risk or to facilitate certain kinds of returns, right? So at the very basic level, you have equity and debt, right? And if you were to look at equity very simply, that means somebody owns a share of something. So you as a founder, for example, you own the company, so you have 100% equity. And then if you decide to raise equity capital, then you're selling some of your shares to somebody else to own part of that. And from an investor standpoint, when you buy equity, straight equity in a company, then you're pretty much taking the residual risk in that business. So in terms of ranking of priority, you rank the list. So the creditors and the other people get out before you in events of maybe bankruptcy or whatever. So you carry a significant risk. But for an investor that is looking to hedge his risk and is not willing to take that level of significant risk, they may be more interested in getting a debt sort of type of investment. And same thing goes to the founder as well. You might be interested in getting debt at that sort of point if you are looking at, okay, I don't want to give out too much equity, and then my business is pretty much de-risked. You know, I have predictable cash flows. I have strong people here. The market is not new. So you might be looking at doing debt. And then there are other factors that you look at. But at the very basic level, you have equity and you have debt. And like you rightly mentioned, you also have other things like convertibles, which are like hybrids. So for example, it's a new business, a startup that is just coming out. You might be very early, you need capital, but raising equity too early, you might end up giving out too much equity and over diluting yourself. So at that stage, rather than do that, you might try to look for something else that gives you the right protection and also gives the investor the comfort that you're not just going to burn the money, because the convertible has a debt element and an equity element. So usually the way that works then is that initially it starts out at a debt, and there are different variations. So some of it might also have interest that accrues on a monthly basis, which increases the principal. And in some cases, you actually even pay those interest payments periodically. But ultimately, at certain events, a liquidation event, you can then convert those shares into equity at a more reasonable valuation, and then you might have like valuation caps or conversion rates in those. And then other instruments that are also used in the startup space are like simple agreements for future equity, which also sort of provides a similar edge to the fact that, okay, I'm early, maybe you've not even built your MVP, but you're trying to raise capital. So you can use those sort of agreements to raise money, and then you might have like valuation caps or have discounts on certain fundraising, future fundraisers that then gives you that comfort that you're not selling your equity too cheaply, and then also gives the investor some comfort as well that they will get the right upside at the right time. So I think those are some of the primary instruments and securities and the nuances around them.
Thanks, Haneef, for bringing up the point, especially on simple agreement for future equities. I was going to take Beverley on that, right? So we see several agreement types. So share subscription agreements, share purchase agreements, SAFEs, like Haneef said. What are the more common types, and what are some of the red flags that founders should look out for? So we see clauses like ratchet clauses, where a lot of founders don't understand what these things mean or how to look at conversion prices. So from your experience, how are some of the ways that founders can get their hands burnt if they're ignorant about certain clauses or certain agreement types? Can you share some of that with us?
Okay. From what I've seen, founders don't really think deeply about those shares that are given to investors and the point at which they actually convert. So when you talk about clauses such as cliffhanger clauses, vesting clauses, they don't really understand that sometimes there's a performance element even attached to it. And if that doesn't meet up, and then ultimately the investors find that they can pull out. So founders, I find, get too excited sometimes at the prospect of investors wanting to come in and invest in their company, and they kind of forget actually some of these things come with certain obligations. It's not just about taking the fundraise and getting all excited about it. There's a lot of obligations that do come along with it at each step of the way. Just like some of my co-panelists talked about, there's obligations at pre-seed, there's at the pre-series, the first series, and subsequent series. So the obligations keep changing, and if you don't have a good lawyer, you'll be absolutely caught caught with like a deer in the headlights. I mean, there have been some very popular and unfortunate cases here, which have been, blown in the public, but I won't mention names, whereby, the founders think that they've gotten the money and they can do whatever they want with it. And then when it's time for them to show, okay, this is the first 5 years, what have you achieved? And because you haven't hit that target, unfortunately, it's not converting. You have to pay some of the money back. And there's the hoo-ha about, well, that's not what was agreed. This was meant to be equity. And they don't quite understand that, okay, there's exactly as the previous speaker spoke of, there's different types of instruments, and all those different instruments come with their own set of obligations. And if you don't understand it, or if your counsel doesn't take the time to explain it properly to you, you find yourself in a fix. So it's really important that, like I said before, that founders, in fact, don't even rely solely on your lawyer. Also do your research as well. It's good to have competent lawyers, but it's also good to understand the nitty-gritty, of what all these different instruments are, how they work in practice, and what the obligations are. Because if you get caught out, you find yourself suddenly with a massive dilution, or you find yourself out totally, or you find yourself in debt that you didn't anticipate. So it's really, really important that those clauses, the nitty-gritty, they need to say, look, I don't really understand this. I know you're my counsel. I know you're looking out for my interest, but could you please explain? I don't understand what this particular clause means, because otherwise they find themselves in a bind. And that happens quite a lot, not just in Nigeria, but, globally. We hear of these things all the time. Deals gone wrong. Founders don't quite understand that, their shares suddenly take a massive dilution because every series, your equity, your shareholding dilutes, and people don't understand that. So it's really, really important that founders get educated. There's so many, for instance, this is a fantastic platform just for educating founders, because they need to understand what it is they're going into, and not just rely on, the professionals. Yes, rely on them, but also do your research as well. Ask, talk to other founders who've had bad experiences, if they're willing to share, that is. Because that's the only way you can avoid, to an extent, getting your fingers burnt, which is unfortunately more common than we realize.
Thank you so much, Beverley. It rings very close to home, and it reminds me of the popular pharmaceutical chain that was in the news, I think, last year, where essentially so this is more towards the P side. A P fund came in, fired the CEO, and it became a mess in the media. I imagine that if someone somewhere had paid attention to terms of that agreement, maybe you wouldn't have got it so bad.
Exactly.
So now I'm trying to take the founder's view, and I'm coming to Dayo for this, right? And this is more on the due diligence side. So investors will typically do multiple types of due diligence. So you do commercial due diligence, tax due diligence, financial due diligence, and even the chemistry between the investor and the founder says a lot about whether or not the deal will be done. So can you tell us what's your due diligence process typically like, and what can founders do to be better prepared for the burning questions you usually ask?
Okay, great. So I know there was something that one of the co-panelists said about, the pre-series stage, where most people don't really think too much about investor readiness. And it's interesting because we're finding more and more people building just so investors can come in. I don't know whether that takes away the passion, like my co-panelist Adedayo, because, you're just there trying to build for the sake of someone coming in. But if that's who you are, no problem. I think one of the things you really need to think about is structure, the teams. We've talked already about founders who don't even have proper agreement as between themselves. So, they're going through a series round, and all of a sudden they're stuck because there's no legally binding agreement that says how much each person has. So how can you possibly go into an agreement with an external party when you've not even got your ducks in a row between yourselves? Also, you need to obviously have the competence. People are looking so much at teams. I think this has been overemphasized in this conversation. Expertise is critical. Investors pretty much look at the team. I think they say, it takes about 10 minutes on average to know whether this is going to be a good deal or not, on the basis of the founders themselves. So if you don't have the right expertise, you don't have the right people in, then that's already a sticking point. Then we need to talk about corporate governance. That's something, again, it's that issue of, you're excited in the beginning, you're passionate, and you're not really thinking about structure. You're not thinking about org charts. Those things are all boring. Let's just get on with the work. Let's just get on with the magic of making things happen. But things like corporate governance go a long way. It goes such a long way because, I have this thing whereby you really need to start as you intend to finish. You're never too small to have good corporate governance practices. You can be you can have a really small setup, but demonstrate good corporate governance. Record keeping, oh my goodness, I can't stress this enough. Investors come in and they're asking, okay, so let's have a breakdown of, say, your records, and you're just seeing money flying out of accounts here, there. There's no proper audit. You don't have accountants you're working with. I mean, there's so much that goes into due diligence, and due diligence is a lot easier, not easy, but a lot easier when from the beginning, the founders understand regulatory is key, especially for those founders that are working in heavily regulated industries. And for the most part, most startups are working in heavily regulated industries. So that regulatory piece is so important. Having your in-house compliance person that's checking the external framework, making sure that it matches up to the internal framework. Yes, it sounds like so much. When you're starting off, you may not even have the funds. That's fine. But the truth of the matter is your team has to adequately meet up to match all the competencies required. Otherwise, you're not going to move forward. So there has to be a lot of multiple hats people are wearing in the beginning. You have to have your finance person doubling up as, say, your compliance person. You have to have your CFO, your COO. You just have to have the right people on ground. We've talked about the need for professional support. Legal, yes, no one is going to, give you a hard time if you don't have legal, but it could ultimately come back to bite you. Same thing with your audits, your record keeping. You really need to have that at the back of your mind when you're starting out. Even if you're 2 years in and you still don't have these things, it's never too late. You have to have these processes in, get them in place as soon as possible, because no one wants to pick up a messy structure. People want an element of, there has to be some kind of structure. So that way the investors can build on that. When it becomes too, amorphous and, structureless, it's like, okay, I like what you're doing, but we're not too sure. And then they move on, because there'll be someone else probably doing what you're doing, remember, but they're doing it in a more organized way. So it's really, really important that founders take structure seriously. And if they don't understand structure, that's where you engage external counsel to assist you. Again, not too many legal people have, say, a compliance background. So I have a regulatory and compliance background, which I guess is handy. So someone like me, I'm kind of like a 2 or 3 in 1. So that's probably cheaper than going with different multiple professionals. But ultimately, at some point, the goal, as my co-panelists have said, is think big. You've got to be ambitious. So as you're scaling up, you're eventually going to have all these different professionals in their own capacity, covering those risks that have to be mitigated one way or the other, because you can't be operating in a regulated industry, you're unaware of the risk universe, let's say. So the due diligence piece, unfortunately, is something that has to be done continuously. Yes, you do it at the beginning so the investors know everything looks kosher, but honestly, it's an ongoing thing. It's a lifestyle, it's a culture. I think Adedayo referred to that difficulty in imbibing that proper professional working culture. When things are doing fine, profits are coming in, revenues coming in, but that culture is so critical. We don't really talk enough about culture, because culture is linked to, how well you're complying, making sure you're not caught unawares, especially in a country like Nigeria, where they can announce a new rule tomorrow that literally shuts down one part of your business. So it's really important that you have the right people who can keep their eyes on the ball for you. But in the beginning, if you don't have the money, then it's just something you have to try and do on your own until you can afford to engage the right people that can basically diligence your business on your behalf. But due diligence is something that for me it's a continuous thing at all stages, because otherwise the risk is too great, because the higher you go, the higher you fall. So.
Sure. I guess the recent happenings of what happened to the ride-hailing companies, and more recently with firms like Chaka and Bamboo, have sort of taught us that, if nothing, at least be on top of governance diligence, governance environment, so you're able to better predict, you're more agile and able to respond to these changes. Well, moving on quickly, I'd like to crave the indulgence of all our panelists. We're almost at time, but I'll ask that you kindly give us 10 more minutes, and we'll close at exactly 1:10. So I hope that's fine. I hope that works for everyone. Okay, thank you so much. I wanted to do some quick rapid fire questions just before we close. So one question each for Dayo, Kayode, and Beverley. And so Dayo, I'm coming to you for this. For your due diligence process as a founder, what do you rely more on? Chemistry with founders or hard due diligence findings? What does it more for you before you cut a check?
Now as an investor, right?
Now as an investor, sorry.
Now, the obvious thing would be, the obvious thing to every investor would be chemistry, but that's a very dangerous concept, right? If you invest based on chemistry, then you would essentially be building a cult of people that like you and you like, where you're probably not optimizing for eventual outcomes. So you should take your personal feelings aside, and then try and be extremely non-judgmental, non-opinionated about the founder. Try and think like a robot, and just try to focus on the merit of the strength of the founder, the opportunity opportunity you are examining, and the market potentials only. Chemistry is important because it's a journey. Also, it's a long-term journey. You want to ensure that you have a rapport with who the founder is. You can think alike, but that can end up being a bias. It can end up introducing a bias to your process, where you're just giving money to people that think like you, look like you, and are probably clapping for you. And that's like a recipe for disaster, But that being said, you want to give money to people that you can advise the right way. But again, that in a journey of a business, from pre-seed to Series F, like my sister said, there are plenty letters now. I think it stops after F. We stop at F. We don't need them letters after F. You should also be humble enough to understand that your value to a company is limited. You can add value to a company at let's say the pre-seed and the seed level, even Series A, but you should be smart enough to know that the support that the founder required to go from a $300 million company to a $1 billion company will not come from you. So do not over-optimize for your rapport with the founder and all of that. Okay, for the support you can offer from the stage you are getting into the next stage, and that's all fine, right? So what is important, like I've said, is the strength of the ambition. I need to be sure that you have like a global view to these problems. And again, like some people have said also, the journey is never straight from what the founder has put in your front, right? The market has a way of evolving even beyond what you set out to do. But if you have like a full scope of the problem, things that are not going to change. If you're saying you are going into the accounting services space, clearly accounting will never change. People need to do books, but the way and manner would always change. The resources and tools will always change. And you should give yourself the flexibility to be able to pivot left, pivot right. But the journey itself must be large enough. You want to do X and Y. You want to ensure that all restaurants in Africa have like a very decent supply chain. That's a large problem. by all means, we can support you. In terms of due diligence, we typically invest at the pre-seed and the seed stage. Like, we think for most African investors, that's the same story. We are more like discovery funds. The big checks that would make our companies turn to $20 million revenue businesses are not yet heavy in Nigeria. So our work is to prepare the companies to be able to attract global opportunities. Essentially, now that we know that our key strength in Nigeria is talent, and we must all build this talent to be able to scale globally. So at that point, what is very critical to me is the people, the assembly of the team. What does it look like? What does the co-founder agreements look? What does it look like? I've had situations where I've seen people to invest in. We've had very solid conversations. They have the head on their shoulders, and then a week before I wire money, and then I'm getting an email that we are fought. We are not doing it again. And so that. So you want to be sure that a lot of people jump into business ideas because of an idea, and it looks so good, all right? But then when it comes to crunch time, things will start to break. They realize that they are not even on the same page. People also hire people that are the most available, not like they intentionally go after the best people. So, and if you're starting a business now, and if he's going to call Yinka, come, let's go and do this business together. That doesn't mean Yinka is the best fit for that role. But because it's so available, right? People get their friends to be co-founders, their ex-colleagues, and then when it's crunch time, you start to see that, okay, this is not the best team. So I like to look at the teams independent of one another. Who are you? What do you bring to the table? If you're a technical person, are you like the best in class when it comes to technology? Are you the best? Are you the next best in class when it comes to marketing? So that even in case there's a founder conflict, I'm assured that at the first step of setting up that co-founding agreement, there was some intentionality about bringing in the right people. So even if the relationship breaks, the person, the lead would be strong enough to look for people of equal standing to replace that role, because conflicts will always happen. And I want to see what previous agreements you've gone into with other previous investors, with founders, because there are some clauses that can make you uninvestable. If you have given a liquidity preference to an earlier investor, then I'm just playing Russian roulette with my own money. If you're not well incorporated, if you're not well structured, if you are going to a license space that you're not thinking about licensing regime, then it's a problem. But for early stage, there's not so much things to bother about like a private equity firm. There's not so many previous transactions. There's not audited accounts. There's none of that. Essentially, my friend from Ventures Partners has said something, right? You hope for the best, but you plan for the worst. The worst is that you can lose 80% of the investment. All right. So because we all know it's a risky game, so we are not we are not going to be so finicky about all the micro details. Even if you don't have audited accounts, you don't have accounts, no problem, because I know I'm taking a risk anyway. But I'm trying to see how I can have like a positive risk-adjusted return in this case. As I want to see how many of those risks that you as the founder you've solved for. If you solve for execution risk by getting the right co-founders on board, then that's solid. If you solve for technology risk by building a proper tech stack, then that's solid. If you solve regulatory risk by talking to regulators already, or having a pipeline to regulators, then I know that you've done all the very hard work, and then I can come in and then see how else I can add value.
Are we losing there? Okay. Oh, thank you so much, Diane. Thank you. And very quickly, I'll move on to Kayode now. I'm just trying to optimize for time here. Clearly, we see that not only founders do not have a monopoly on ambition, because Kayode is trying to look for an investing company that will return 500% of his fund. But if you take a step back from that, can you describe to us very quickly, what's your credit process like? How long will it take to go from getting a teaser, oh, Kayode, I have this bright startup, I'd like to talk to you, to cutting them a check? What's that process like, and how long will it take on average?
On average, that process is 2 to 3 weeks. In certain cases, we've done it under a week. And in extreme cases, we've done it in a couple of days. So it depends on a number of factors. So I guess that answers the question of the timeline. In terms of the process, there are a number of things. For us, usually we get an inbound, and an inbound could either be a referral from existing portfolio. It could be a referral from scouts within our network. It could be a referral from people within our network, or it could be just a direct application on our website, right? So usually, I mean, if an employee in an existing portfolio is starting a company, which we're beginning to, as our portfolio matures, we're seeing things like talent recycling, where an engineer leaves space to start a new company. We funded 2 of such companies. In such cases, those deals will most likely be faster, especially if we already have a relationship with that person already. We know the person's competence, we know what we know their capability. It just becomes a question of what are you building? Is there an opportunity for this? Who are you building alongside with? And we do a lot of the DD. So those sort of cases are faster. But typically we have an inbound. We would, if we like the inbound, would most likely set up a first call with the founder. So this is like the exploratory. We want to just hear. In that case, we're basically judging the founder. We're evaluating the founder on how they're thinking about the market. You know, is there unique insight? You know, just generally, how is this founder thinking? You know, how is it thinking from first principles? You know, because things are going to change. And usually when you're going after a problem, what we see is that there are usually 4 or 5 people going after that same problem. So we're asking ourselves, is this the best guy? And we typically don't like funding companies that are directly competitive. So we're asking ourselves, is this the best guy to go after this opportunity? What does he know that the other guy doesn't know? What unique insight does he know that what like? So we're evaluating that. Usually, if we like that, we then move you to a joint partner call with the general team. You know, we dig a lot deeper. We do a lot of research into the business. In certain cases, we want to talk to some of your customers. In certain cases, we want to, depending on what you're doing, want to talk to your supply chain. You know, if you're a lot more advanced, and then you know after 2-3 calls, in most cases, we're able to arrive at a decision if we want to invest in you or not. And that can happen over a week or 2. And then we go into the moment we decide that we'll just take that deal to our IC, which is the investment committee, which most VC funds would have, you know, to get their approval. And then we go into due diligence, where I believe Beverley have spoken extensively about that, you know, so we're checking founders' agreements, we're checking is there investing agreement in place, you know, it's also become more important to have things like, you know, sexual harassment policy, you know, things like that, you know, how are you thinking about, you know, we essentially check all the agreements, and in certain cases, we don't expect founders to have all this legal agreement. We then do a side letter that then commits you to say over the next 6 months, I would ensure that this and this are in place. We typically would prefer companies that are not incorporated in Nigeria for obvious reasons. Even for your future fundraising needs, you need to essentially be incorporated outside of Nigeria, because no US investor will give you money if you're a purely Nigerian company, right? So you are probably going to be, you know, incorporated in Delaware or, you know, Mauritius or somewhere, right? So essentially, we do all that process, and then once you are clear on the DD, we then wire check almost immediately. So this everything I've described takes between 2 and 3 weeks. In certain cases, it's shorter, and in certain cases where we're so bullish on the deal and the deal is moving really, really fast, in certain cases you probably will do maybe a week or less.
Thanks, Kayode. An upper bound of 3 weeks is pretty impressive. Later down the cycle on the PE side, deals take as long as a year. But I guess this is good news for founders.
Early stage, right?
Early stage, yes.
So we want to move fast because the founders are moving fast. And a lot of the good companies today, trust me, are finding it relatively easy to raise money. So like you can't sit 8 weeks. I mean, they like you, they want you to deal, but like, no, fam, nobody's gonna wait 8 weeks for you to make a decision.
Yeah, I guess if you don't move fast enough, you can lose a share of the pie as well. But so unfortunately, we've come to the end. There's still so many questions for everybody, but we'll have to close to be mindful of time. So thank you so much, Beverley. Thank you so much, Dayo and Kayode. Thank you, Haneef. Thanks to Abdulsamad and everybody working behind the scenes. We appreciate your time, and we hope the founders on the call have learned a thing or two. If you have any further questions, send it to the email. Send it to Abdulsamad's email or Leonine's email, and we'll be in touch. If they're too technical for us to answer, we'll on your behalf reach out to the panelists and hope they can oblige us by email. So thank you so much for your time, and have a great weekend, everyone. Thank you.
All right.
Thanks so much.
Thanks a lot, everyone. All right. Bye.
Bye.
Bye.